this show on the road, gentlemen. So since the end of March, equity and bond markets have continued to slide into negative territory, with the NASDAQ, the small cap indexes, and the S&P 500 all falling into officially bear market territory, which, if you didn't know, is down more than 20%. While the commodity complex, represented by oil, gas, and food commodities, has ripped higher by double digits, creating historically high inflation, putting global economies at risk of recession. Woo! It's been a while. It's been a long, long time since investors have had to maneuver such shifty stones under their feet. In fact, gentlemen, did you know most investors have never been through a bear market, let alone even maybe invested during a time of inflation or recession? So luckily for you, we've been there. We've done this. We've seen this before. And what we learned in the previous bear markets is helping us today, because a lot of the same patterns are unfolding in today's markets, just like they did back in 2000 and 2008. So in the next 20 to 25 minutes, what we're hoping to do is share with you what we have been doing and what we're seeing, how markets are unfolding, and the things that we've been doing for our clients that's working for them in this particular environment. And we're, more importantly, going to answer the biggest questions that we're hearing from people, like, hey, what about interest rates? Are they going to the moon? Or the very famous one is, holy cow, how crazy is the stock market? I mean, how much lower can it go? And of course, the big question that we get to is, with inflation and recession around the corner, what should I do to protect my money? And Justin, Patrick, you know, the favorite one that we always get, the best and brightest, I mean, this is my favorite, which is, hey, I keep getting these emails. So, like, what about gold? I get these emails that are saying the dollar's doomed and I should buy Butterfingers, bullets, and gold bars. Should I? Well, those are the questions that we're going to answer today. So welcome to Quiver Financial's Taming the Bear Market. I'm Colby McFadden, and as always, I'm joined with Justin Singletary, Patrick Moorhead. Gentlemen, let's jump right in and start by giving everybody a little update on where markets are year to date to kind of set the tone of what we think is going to happen as we go into the tail end of the year. How are you guys doing today?
Doing great.
You look beautiful.
It's nice and shiny, right?
Yeah,
Nothing less.
You guys are hot. Let me tell you. You guys are hot.
Couple
Your
of
pictures.
cue balls.
Yeah. Well, we just replaced your bear with your picture with a scary bear picture, right? It looks like we're, a high school bear, right? Yeah. We replaced your ugly mugs with the bear. So here's where we are year to date, guys. The S&P 500 is down roughly 19-20%. NASDAQ 26% in the red. Corporate bonds, so a lot of the high-yield corporate bond market down 15%. And the 10-year Treasury, now that's been the thing that surprised, well, it's not so surprising, but I think that's what is surprising people when they open their statements, is that the losses in the bond market have been extreme. Because even though we say the 10-year Treasury has gone from 1.5 to 3.1. That's a huge move, okay? And what happens there, folks, is your treasury bonds, your government bond funds, the things you tend to go to for lower risk kind of safety, your hedge against the stock market, well, when interest rates go from 1.5 to 3, a lot of those low-risk investments become high-risk, and they're seeing even double-digit returns. I've seen things like U.S. Franklin Income Fund down 12, 14% at points in the year.
Right.
I mean, this is stuff like 90-year-old ladies own, right? I mean, talk about get your knickers in an uproar. So now, and then on the other side, you have, like, the biggest disappointment. I mean, the biggest disappointment since all of us were in high school is gold, right? Gold has done nothing, but hey, it hasn't lost you money. It's been flat. And then the commodity complex, the stuff that everybody left for dead. Last year, anybody want to own gold? Remember when oil was like $12 a barrel, $15 a barrel?
Yep.
When we were worried about companies going bankrupt, right?
Yep.
And now 120, 110.
I'm hearing 180 later this
year.
year.
Yeah, we hear these things, but so it's ripped up almost 50%. Natural gas. I mean, hey, if you want, we've been saying it a long time. If you want to play the electric car game, natural gas, right? And I haven't even put coal up there. I mean, talk about something nobody wanted to see happen. But nonetheless, food commodities up a third, up 30%. So I mean, this is inflation at its best, folks, and nobody's used to investing in these times.
I think we're all seeing it too in our pocketbook. I mean, everywhere you go out to eat, everything's $20 or north of $20. You can't get anything less than spending $20 for a cheeseburger.
Yeah.
Well, and the government solution is just to throw more money at it, which California announced the other day. They're throwing more money at it, which is just going to cause more inflation. So.
Yep.
Yeah. So what can we expect as the year progresses? I don't think the inflation story goes away. Obviously, one thing we have to remember is that inflation usually is the cause of recession. Like when you do your homework and you look at what happens in markets, there's never been a recessionary time that wasn't preceded by a big spike in inflation.
Right.
A big run up in prices is usually what causes a recession or a pullback, right? So let's get into the first question, okay? So let's start with that flat part of the market. Talk about that big question that we get from people of, what about gold? I keep getting these emails, right? I get these emails that tell me that I should buy Butterfingers and bullets and gold bars. Should I buy those things? Should I be buying gold bars? Should I buy? What's going on there? And
yes,
really,
Butterfingers are awesome.
Yeah. Well, I think in our newsletter we said eat the Butterfingers, send the bullets to Ukraine, and you might want to consider gold because by the charts. And it's important, I'm grouping gold and the dollar together because they tend to have a relationship. Typically, when you have dollar strength, commodity complexes don't do all that well during dollar strength. And you really typically see that more in the metals than anywhere else. And that's been the case. We've had a lot of dollar strength. So I know all of you getting those emails are talking about the dollar is doomed. Well, just look at the charts, and you're going to see in this chart of the dollar that we're sharing is this goes back from 2019. And I can show you charts that go way back further all the way to 2008, and you'll see that while you're getting these emails, dollar strength has really been the case. And what happens in financial crisis like we've had this year is typically the dollar will gain strength first. And I saw this in 2008. The dollar was strong when everything was falling apart. And then in the second half, when it really became obvious that we were going into recession and the market participants started to realize, oh, the government's going to have to be accommodative, then the dollar got weaker and gold took off in the last half. So I'm looking at the charts, and we've been in the dollar. We've been, that's been a big part of our allocation. I've been looking for places to start to wean that down because I can tell by the charts we're coming into an area that we should expect the dollar to possibly pause, even possibly contract a little bit. And what's interesting with gold is that this 1 year chart of gold, pay attention to the green line, because even though we were saying earlier, gold's been the big disappointing, asset. It hasn't made anybody money when you thought it would. Justin, you were saying this earlier. You thought gold would be moving.
Yeah, at this point, I mean, especially with all of the emails and different things that we get and hearing from folks, it's like you'd think by the way that they send out those things, gold should be at $3,000 an ounce.
Yeah, you'd think,
but not anywhere near it.
No. But I'll tell you, it's an interesting place because you've been resting on this line of support that if I show you another chart that takes you back further, it's an interesting line. I mean, you can draw this line of support all the way back to 2015, mid-2015. And what I find is that when you find lines of support like this that have been existing for a while, you got to pay attention to them. So I think this is a really key level for somebody who's been thinking to themselves, hey, you know what? I just hit Rite Aid. I grabbed some Butterfingers. I'm swinging by Grant's, and I'm going to grab the bullets. And, maybe should I swing by the Quiver office and get myself some gold?
Some GLD?
Yeah. So I mean, here's the thing, risk reward, right? The nice thing with this is that if you have a nice fine line like we've drawn there, the trade is this. if you're an investor in gold, if you can handle the risk, and this is not investment advice, always double check with your own advisor, blah, 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 blah. All right. But if you were to try something, that green line is your key. As long as gold stays above that, we may have a bullish situation where it's going to go into this final wave of growth that really started back in 2015. If you break below that green line, that analysis is dead. It's off, folks. You throw it away, get out of the asset, essentially, right? So that's where technical analysis comes in really, really handy. And fundamentally, I think we're right at that kind of time frame where people start to realize we're sliding into recession. And as they do that, they're going to start to expect the Fed to do something. So all this rising of interest rates and tightening of money policy could shift or change, not today, not tomorrow, but it's something that I think the market's going to be looking for.
Well, and I think it's fair to point out, from the top of 2008 till now, gold still made, a 5-6% kind of return. It's
been respectable.
Flat year. So if you got a time horizon and you were to do it, I mean, it's not a total dog or dead weight, but it's just might not have the return potential of the stock market. So
Sure. As an individual who can afford to have an asset not go anywhere, not a big deal. As professionals, where we're always looking at relative performance, should I have it here or there, it does make a difference. And I will tell you right now, our particular models are sniffing out more of an opportunity of adding it to the position because we've had our smallest allocation in gold that we've had for a good 2 years. So it's just interesting that maybe it stops being a disappointment.
Let's hope so.
Yeah.
my parents are still hoping for that.
Yeah, I mean, you can see on there, I mean, I know Patrick said from 2008 to now, but even if you were, let's say you purchased in 2013, you had no growth, no nothing for close to 10 years.
Yeah, it depends. Yeah, there again.
Time frame, but
there's buy and hold, and then there's strategy and tactics. And so if you're going to be a buy and holder, the risk you run is sometimes it becomes dead money
for a long time.
Yeah, so that there's different strategies. So let's move from there because while the dollar and gold look like they could be switching batons here in the near future, something to be aware of. I think the thing that's really affecting portfolios the most this year is this move in interest rates because everybody's asking us, how much further can they go? I mean, 1.5 all the way up to 3. You've doubled the 10-year. The 10-year Treasury has doubled. And when you get these parabolic moves, what should we expect is everybody's question. So I like to go to the charts. And the one thing that I know about interest rates is that interest rates tend to trade in a range for long periods of time. That they tend to really trade in a range as we're figuring out where their true economy lies. So if you look at this chart here that goes back to 2013 of the 10-year Treasury, you can see that even though there's been a lot of hype around interest rates rising, we're really just at the same spot we were back in 2013, not much higher. So we've been trading sideways, and from 2013 to 2019, for 6 years, we basically traded between 1.5 and 3, just like we did recently. The difference is this happened fast, right? It happened really fast. I counted out, it does look like you got 5 waves up. Usually on the 5th wave, you're going to expect the move is coming towards an end. That 5th wave does look extended. And the one thing about extended 5th waves is they can snap back to the point of origin a lot faster than you'd imagine. So nobody's talking about this right now. Everybody's anticipating higher rates, higher rates, higher rates. That's what everybody's talking about. But after the move of being so parabolic, I'm a little curious to see what happens over the next couple months. Do we get some kind of, at least a pause, if not some kind of retraction back? Because it's hard to believe that it's going to keep extending.
Over the longer term, too, the Fed usually tightens or raises rates prior to the recession and then brings those rates back down, which will have an effect over the longer term, too, for that. So
yeah, you bring up a good point is the Fed, they tend to overshoot. Yeah. Right. They tend to start to raise rates a little too late is what we've seen, and they go a little too aggressive too late, and then they have to wheel it back.
Yeah.
So that's the big question that people have right now is the Federal Reserve going to change their tune? Are they going to become the Paul Volcker? You know, are they going to really raise rates and stomp it out, or are they just going to do what I think most people expect is you go back to your past behavior. You know, the moment that your children start crying, don't you just give them something to pacify them, right? Like, hey, here's your iPhone. Sit down, be quiet, right? So I think markets are the children, and the moment the markets get low enough, you know, or you start to put damage in housing, then things start to change. I think
a little
for the Fed.
retraction come back that way.
Yeah, this chart's interesting because it goes all the way back to 2007, longer time frame, and you can see this channel that we've been in. It's been a downward sloping channel. So maybe the history in front of us is that rates start to bottom out here, you know, longer term, and the future is we trade between 1.5 and 3, and then if the economy starts to grow, maybe we start to trade above 3%. So that's what I'm thinking happens next. So what you would do as an investor in this particular situation is if you're looking at your portfolio and you're seeing that your bonds took a big hit in the last couple months, you may not want to panic yet. You may want to, you know, sit down and think strategically about how do you create recovery. Because sometimes creating recovery is a contrarian approach than what your emotional feelings are.
Yeah.
Do you guys have anything else you want to add on interest rates or, you know, the effects of anything that?
Not on rates, no.
Any questions anybody's asked you guys about it?
Just the same ones we've kind of covered. Are they
If
going
we
higher?
were to keep going, how much further?
Well, so right, it's a great question because I gave the downside, right? You know, by looking at the chart, 4%, like seems like that number. Like if the market I think if the market wanted to create the biggest surprise, it'd do one of two things, and that's what markets love to do. You know, the goal of the market is to create maximum frustration to the maximum number of people. So if it wanted to do that, then it would either do one of two things: just explode up to 4%. Right, and that probably would tank equities a little bit more. Equities would just be like, especially the Nasdaq, would just be like, shit,
Bye bye.
Yeah, you know, like you know, Kathy Wood would just be, you know,
Finished.
yeah, be whacking herself with wood. Or you reverse here and you quickly go back towards 2%, like in a big surprise, like you just get a huge rally. The one concern I have with the whole huge rally thing is I do believe there's a geopolitical thing going on here. Is I do think a big part of the rise in rates this year has been China and Russia and some of our essential enemies selling into that market.
Right.
Because you have to remember, like China, the people running China, I mean, they spent many years in communes reading one book, you know, studying Marxism, studying, you know, guerrilla warfare. And in guerrilla warfare, you know, it tells you if inflation is a problem, close your ports, jack inflation up, and then open them back up when energy prices are high and flood it again, right? So same thing in interest rates. Guerrilla warfare would be, hey, if your enemy is already seeing higher interest rates, keep selling your bonds to push rates higher. You know,
right.
And there's a lot of financial warfare that happens between us and them that a lot of people aren't aware of, and I do think that's a big factor.
I agree.
You know, the thing is though, it's hard. We got big bazookas. You know, the U.S. we have big guns to be able to buy our own debt. We've seen that. You know, and if you're going to buy any debt, why not buy ours?
Right.
You know, so, all right, and that's really, you know, a lot of this is fueling that same geopolitical situations, fueling the big question that we're getting, which is, holy shit, how high can oil go? How high can gas prices go? I mean, $6, $8. People are talking about, well, we see $9, $10 gas. You know, and we talked about before. China was halfway closed down for a while. Now they're opening up. You know, with the demand from China, shouldn't we expect more pull on commodities? And I'm really torn here because oil and gas have had a hell of a run. I mean, the run's pretty long in the tooth. And there's been a lot of Johnny-come-latelys that have come in saying, predicting higher oil and $200 a barrel prices and stuff like that. And I remember in 2007, when Goldman Sachs came out and they gave their, you know, peak oil thesis that, it's going to $200 a barrel, right? And it was like 110 at the time. And then we found out that right after they released that paper that, you know, they're selling their oil into the market. You know, they're just unloading it, you know. Hey, it's going to be 200. Here, take it at 110.
Right.
You know? So, you know, with commodities, they move fast, right? And when I look at the charts, especially from the COVID bottom, what a hell of a run.
Yeah.
I mean, holy cow. So, you've got to be, anytime you have something that runs like this, if you're going to enter in late, you better know your risk management. Now, we talk about this because we've been in this for a while. So we're playing with profits. So I'm going to talk from two sides, is that if you have profits like we do, we've got a lot of wiggle room here. But if you're somebody who's entered into the oil or gas market recently or are trying to, you got to be very careful when we're at because a change in trend could happen at any moment.
I think we've started to see a little bit of it, and I don't know if that's long-term as it is short-term. And by that, I mean contraction.
Yeah. So like I'll point out, I don't know if we can see it up here, but so that line where we say is the super uber bullish line, the dark green one. So this week we did breach that a little bit. Yeah. We whipsawed below it, and then we came back above it. That's really your short-term tell. Like if oil is going to stay in this uber bullish move, it probably should not sustain trade below that. So that would be my first big trend changer. Like right now it's threatened. It's definitely on a high alert, but until you get sustained trade below that uber bullish line, then the trend's not broken quite yet. And the scary part is that the longer term trend line, the more intermediate one, like a year to 3 years out, that trend line's all the way down at $100. So you could drop, 10% and still be in a bullish pattern.
Right. Yep.
So if you're new to oil, just realize you might have to take on a lot of volatility before you get positive. So I just would play small at this stage.
Well, and be careful of the talking heads because they're up back again, bullish.
Oh, the
oil.
talking heads are back again, bullish?
Mm-hmm.
Oh, like CNBC?
Right.
Oh, wow.
Yeah, your
And
boy Jim Cramer.
a name we shall not mention, or we are going to mention.
I don't think I get that channel. Until they call me and want to do an interview. Then I'll get that channel. So now the big story, though, is now oil, sure, it drives your gas prices, right? So a lot of people are like, what can I do? What can I do with all these oil prices? Well, I mean, the obvious thing is if you have the risk tolerance and the ability to, own the oil stocks.
Yeah, at least you get a little dividend, you get a little something back.
My best mentor told me I was probably 5 days in the job, and he said, Colby, you want to know how to make money? Find whatever company is screwing you and invest in them. Right? And I was like, Mom, it sounds like a good point. And so, yeah, okay. So, if oil and gas companies are screwing you, invest in them.
Yep.
Right?
Yep.
So the big story, though, for people that was left for dead is natural gas. I mean, here is a chart of natural gas from 2013, and if I showed you back further, I mean, this thing was just 10 years of nothing but declines and losses and declines and losses. We had so much natural gas, right? And now it looks like it's on a new secular trend. Now, secular is long-term, meaning that more than just a couple weeks or a month. So we drew this channel here because if this is a secular bullish trend where natural gas makes higher low makes higher lows and higher highs, right? Keeps going from the lower left to the higher right, then we want to have it stay within that green channel. You break below that green channel, the pattern's dead. You break above that green channel, things are getting a little too euphoric. You might want to consider taking profits. But that channel's now been there for almost a year and a half, 2 years. So it looks like we're on a trend for natural gas. And there again, if we're going to electrify everything, cars, boats, trains, people, whatever.
Export to Europe.
Yeah, exactly. If everything's going electrical, then we got to power that somehow. And, wind and solar ain't going to do it yet.
No.
So natural gas obviously is the winner. Plus, again, global things going on with Russia and China and everybody else.
Yeah, there's been a lot more plants being turned back on, natural gas plants.
Yeah.
I know that there's been some rhetoric with other things, but there has been, at least here in California, I think we've turned on an additional five or six natural gas because of all of the influx of energy that everybody's been needing. And now we're getting into the summer months. So they're telling us we can't drink our water and we got to turn off our AC because we can't handle the energy.
Well, it's a crazy concept because I mean, like we've talked about nuclear before, and I read I saw a comment from a very bright guy who talking about France that they went from 90% nuclear, they're down to 60 in that process because they took on, in order to meet their EU mandates, they took on wind and solar, but in order to produce energy from the wind and solar, it has to transmit through a coal plant. So they had then to fire up a whole bunch of coal plants, right? Real smart, right? So how green and efficient is all these guys being, right?
Right.
So there again, it's like everybody who's playing the whole green thing, the ESG thing, I'm telling you right now, the biggest benefactors are going to be the energy companies because they got the money. They're just going to wait for all these ESG and green people and wait for the venture capital guys to blow their dough. And then they're just going to come in and acquire everything at cheaper prices.
Right.
And you're still going to be dealing with Exxon and Chevron and all these other things. But along the way, everybody's going to be like, oh, I'm doing my part. I got my Tesla. So whatever.
Well, and I think people forget that natural gas comes from the drilling and production of getting oil out of the ground. So, I mean, you can't have one without the other, really. So
Yeah.
it's one aspect. There's other ways to do it, but
I love the
gotta be
environment. I love the environment, but it's just, don't give me a sham on one thing to convince me of another.
Right.
And it's like, let's just be legit. We're too smart. The internet's too strong, folks. All right, let's wrap it up with what everybody really wants to talk about, which is the Marsha of the family, the stock market. So how much further is the stock market going to fall, and when will the decline end? Now, I'm going to tell you, folks, we've been pretty dead on our charts, right? I mean, we've really should pat ourselves on the back, but not get too cocky. So what looks like is in this intermediate time frame pattern that we're showing here, and this is the last year of the S&P 500. We've had other charts. I'll show you in another slide in a second. But right now, it looks like we're working off of a high that lasted for 10 years, and now we're into this first mega wave of a bear market. So I'm expecting it to go 5 waves down. We've done 3. I think we get a little bit of a rally in the near term, maybe through the 4th of July. And then I think after that, we may get a new low. So that's what we're anticipating here within these charts. And the reason that we're feeling that way is because when I pull the chart out and I look a little bit longer, there's a lot of chart confluence around 2,800 to 3,000, 35. Basically, between 3,000 and 3,500, there's a lot of areas where the charts, long-term, short-term, intermediate, really collide. And I've just found that when you find those areas, that sometimes those are a good target for. They seem to be an attractor there. So I don't think the overall downside in the market is over yet, but I do think we've done at least 3/4 of the way. We've done a lot of most of the damage. Yeah. If you're short the market, the easy money's probably been made. Now it becomes a little more difficult.
Yep.
And if you're somebody who's been sitting on the sidelines waiting to buy the dip, then okay. You might be coming into a time frame where you could start to consider that, but I would highly suggest there's a very big risk that this is a huge much bigger bear market than people are talking about. So if you are a buy the dipper, I would highly suggest that you do it in very, very small increments, what we call position sizing.
Yep.
Start small. Leave yourself a lot of extra cash. Bear markets, you do not want to take on too much risk too soon. Because a lot of things are still at very high valuations. And, we've talked a lot about that.
Yeah, I don't think we've reached max pain yet.
Yeah, well, I mean, these charts here, and everybody can visit them on our blog, and I highly, highly suggest that you visit our blog and take a look at what we've done in the past, because it really kind of shows you that we just don't make this stuff up. I mean, like you can go back over the last 3-4 months and see what we charted out. And it's not like the lines are there and then we put the numbers, right? So we've really broken this down, and we do feel that there's more downside there. So I think position sizing is a big thing there.
Yeah. And even though we feel there's more downside, and we've said it in other videos, we position it so that we're nimble enough that if the charts tell us something different, after we've been in there, we can adapt and change.
Yeah, pivot.
That's why we use 5 asset classes, right? That's why we look at stocks, we look at bonds, we look at real estate, we look at alternatives, we look at commodities. All those are elements that need to be within the portfolio, because if the stock market ain't doing it, no big deal. Just go to something else.
Yep.
Yeah.
It's not that, and that's
They're not the only game in town, as Jim Cramer loves to say.
Well, I mean, hey, a lot of people have 60-40 portfolios, and they're never going to change from that, because their advice isn't going to change from that.
Right.
And if you did that in the 70s, you would have never made any money. And so this is one of those times that investors have to step back and ask themselves, am I in the 90s? Am I in the 2000s? Am I in a time frame where interest rates are just going lower and money's freer and freer and valuations can keep going higher? Or am I in a new phase where equities may not be the wealth builders? They could be the wealth destructors, and things like commodities and other alternatives become the place that you have to turn to make your portfolio work.
Yeah, I mean, Facebook's down 70-some%. It's a big percentage. I don't know what it finished up today, but 70-80%.
A lot of big names.
NVIDIA, Google, Tesla. I mean, they've all been whacked pretty good.
Yeah.
So
all right,
be prepared, folks.
Yeah, I would say this. Let's wrap it up. And if you want to stay up to date on the market trends, as well as different ways that you can keep your investment portfolio optimized for bull or bear markets, then visit the Quiver Financial blog site and subscribe to receive our newsletters. The market minutes from the boardroom. You're going to love it. We do all kinds of fun stuff in there. So until next time, take care, folks.